Hey everyone, and welcome to Talk ETFs. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. Sometimes it's easy to forget, but the ETF industry here in the US is made up of much more than just Vanguard and BlackRock. There's dozens of ETF issuers out there, each competing for investors' dollars. Sometimes they're successful, sometimes they're not. Amplify ETFs is one of the successful ones. It's the 35th largest ETF issuer by assets under management, and it's been having a good year. Aggregate inflows for its ETFs have been just short of $400 million. It's got an eclectic mix of ETFs that a lot of investors will find useful or interesting. That's why I'm excited to be speaking with Christian Magoon, the CEO of Amplify ETFs. Welcome to the show, Christian.
Good to be here and good to see you virtually.
Christian, I want to start off by asking you about your biggest ETF, DIVO, D-I-V-O. This is a $3 billion ETF, and it was also a finalist for ETF.com's ETF of the Year award. Can you tell us what the strategy of this fund is? And specifically, I want to know whether this type of dividend income ETF makes sense in the current environment where treasury bonds are yielding close to 5%.
That's a great intro. And yeah, DIVO is a fund that we launched in 2016. It's one of the original Amplify ETFs, but was really overshadowed by many of our thematic ETFs, given kind of market conditions back in that time frame. But really, the last few years, DIVO has shined and become our largest fund at Amplify, and it's an actively managed blue chip stock fund that looks for companies that are growing their earnings, growing their dividends. And then the manager, not only on top of their active security selection, has the ability to tactically write covered calls on the portfolio. So while it does generate a somewhat attractive income, more so a few years ago with interest rates lower, I think income is around the high fours, close to 5% on average from dividends and income. But really the mandate here is total return. So its 3-year annualized total return is 15% a year. Not exactly what you'd maybe expect looking at a high quality group of companies that are dividend payers. This has been really we think some superior security selection as well as some savvy option writing to kind of give you the best of both worlds. So I think that's why it's grown so much, Summit, in the last year and a half, is that kind of offers you the best of both worlds. We have funds that yield double digits, and people sometimes want to move towards those areas, but a lot of times when you look at their total returns, they're single digits. So this is, I think, a nice blend of kind of above average income relative to, say, a dividend ETF, but with additional total return potential in the form of capital appreciation. So DIVO's, a 5-star rated fund in the top percent of its peer group. So we feel lucky to have that as part of our product line at Amplify.
You have an international version of this strategy as well, right? iDIVO?
Right. So beginning last year, we started to look at other opportunities, and we really felt like international from a valuation standpoint, both absolute valuation and then also relative valuation to U.S. stocks started to look quite attractive. And we spoke with the portfolio management team of DIVO, which is Capital Wealth Planning, Kevin Simpson and Josh Smith, and really worked with them on developing an international version of DIVO. So the same active approach to stock selection, looking at companies growing their earnings and growing their dividends, and then also this tactical covered call overlay. And what you get is really a similar, international version of DIVO, but a little bit more income because there's a little bit more dividend potential and really volatility in writing calls. So more like a 6% average income stream from iDIVO, again, with the potential for total return. So as some investors relook at international or increase their exposure to international, I think we've seen 30% of all inflows into ETFs this year go into international equity ETFs. iDIVO is kind of a nice way to dip your toe in the water because you are getting paid to wait in this product to the tune of around 6%. And then you also have that upside, hopefully, over the longer term in terms of getting that capital appreciation from owning those high quality companies. So we think DIVO and iDIVO are a real attractive combination. And indeed, we've seen some nice response out of the gates to iDIVO in terms of AUM. I think it's been our third best AUM gatherer this year.
Since we're on the topic of income, why don't we talk about two of your other ETFs, which are offering those double-digit yields that you referred to earlier. NDIV and YYY are the two ETFs. Why don't we start with NDIV? I know that energy companies today are prioritizing giving cash back to shareholders over investing for growth. That's got to be good for this ETF, right?
That's absolutely right. And that's kind of the investment thesis behind this natural resources dividend product. So, it really owns energy and materials companies. So there's some mining companies in there as well. These companies are essentially swimming in cash, and they've learned from kind of previous cycles that they probably shouldn't do as much spending on future projects because they don't have a great track record of kind of deploying that capital. And instead, they're deciding just to pay this out in the form of, share buybacks, special dividends, and increased regular dividends to shareholders. So our ENDIV ETF, which owns these kind of large cap companies in natural resources, again, energy and materials, yields over 10%, which a lot of people, if they haven't looked at this area, are really surprised about. But when you actually start to research this, and you've written some stories on this, these types of companies now are just kind of sending their cash out the door. There is some fear with some of these companies that they're going to kind of be eaten by this energy transition, so to speak. And, a lot of these are fossil fuel oriented companies. However, many of them are also doing some, projects in the future. And the interesting thing about this kind of mix of energy and materials companies is on the materials side, you actually do get exposure to some of the companies that are mining some of these metals that are going to be very important for electrification of fossil fuel. So it's not a total, fossil fuel play. It really does have some balance. In the meantime, you get paid pretty handsomely from a cash flow perspective, which I think, based off the markets the last 2 years, investors are valuing more of that, dividend income as part of their total return than ever before. So NDIV, we think, is well positioned for people looking at energy or materials and, seeking to actually get paid something from that allocation to the tune of maybe even double digits.
And what about why? I know a lot of investors are confused about closed-end funds. Can you talk about what those are and how this ETF benefits from investing in them?
So closed-end funds predate the mutual fund in the US and certainly the ETF. They're the original fund structure that was in the US. And, there's over 500 closed-end funds that trade on primarily the New York Stock Exchange. Why did that fund structure become less popular? And the reason is there's a set amount of shares relative that trade on behalf of the fund on an exchange. And because of that, when there's more sellers of those shares, the price actually can disconnect from the NAV and go to a discount below the NAV. Likewise, if there's more buyers of those shares, the price can actually go above the NAV and go to a premium. ETFs can shrink and grow their shares to kind of deal with this premium discount. Closed-end funds can't. So that was a reason many people kind of shied away from closed-end funds, at least buying them when they initially launched. Well, there's an opportunity actually here if you concentrate on funds that are liquid, that have a fair amount of market cap as well as average daily trading volume, and you look at these funds that are actually trading at below their NAV. Now, I think on average, closed-end funds trade across the spectrum at about a 4% discount to NAV. So we're looking for funds that are trading at discounts in general. And I think YYY takes the approach of basically an index-based selection, looking at not only the distributions funds make, but also their premium and discount as well as their liquidity. And in the end, buys about 45 of the 500 or so closed-end funds that trade in the marketplace. It's an index that refreshes several times a year. And I think right now we're buying the average closed-end fund at about a 9% discount. So believe it or not, the groups that manage these closed-end funds are some of the largest asset managers in the world. They're the BlackRocks, they're the PIMCOs, those types of firms. And believe it or not, you may be able to buy, $100 of assets for, in this case, $91. And what that does is it gives you increased income potential. In addition, closed-end funds often use leverage, at least closed-end funds that invest in fixed income. So they'll borrow sometimes up to a third of their portfolio. So if it's a $100 million fund, they may borrow $33 million and reinvest that $33 million in kind of their strategy that would yield above what current Fed funds or SOFR rate would be. And that spread is additional income. So you have additional income potential. Now, that's actually hurt closed-end funds over the last year as rates have risen. But now in anticipation of potentially the Fed pausing or pivoting, it could actually be a nice tailwind for closed-end funds. and maybe even help eliminate some of the discounts that are there. So there's several ways to kind of benefit from closed-end funds based off your price relative to the NAV if you're buying at a premium or discount, the actual underlying strategy's performance, and then kind of what rates are doing. So currently YYY yields about 12%, if you can believe that, across these 45 funds. Around 75-80% of the portfolio is in bond closed-end funds, and the remaining are in equity-oriented closed-end funds, mostly covered call funds. So it's an interesting way to participate in the inefficiencies of the closed-end fund market and hopefully get above average yield. This really kind of fits, in our belief, with investors who maybe have a shortfall in income and need to kind of increase that monthly check, if you will. And that's where this allocation fits. Over the longer term, the total returns aren't double digits. They're more like single digits. So it's important to understand there is a trade-off, like there is with most ETFs that yield double digits, where that yield is really kind of that high current monthly income is kind of the carrot that people get, and kind of the price they pay is usually a lower total return over time. So another kind of interesting solution there for those who are looking for, maybe double or more the current money market rates, of course, with a lot more risk and volatility, I should say.
Well, that's a great place to end it. Christian, thanks so much for taking the time and sharing your insights with us.
Thanks for having us. We really appreciate it.